When you're dealing with real estate situations, you're always trying to make it so that you're in win-win situations. You're always trying to solve problem so that there are no losers. Everybody is made whole. And when you're in a situation where people are defaulting on their loans or you're having to repossess homes, there are people who are losing, and there's nothing that you can do about that. And that is probably the most stressful side, is when you can't resolve something in a way where everyone is left whole.
If you've ever wondered how real estate investors actually build their businesses, not just the wins, but the setbacks, the pivots, and the lessons in between, you're in the right place. Welcome to Let's Talk Real Estate Investing, where we have honest conversations about what works, what fails, and what you need to know before your next move. Hi, I'm Debbie Balfour, real estate investor and investor success coach. I help real estate investors fund their deals through a relationship-first approach by building a pipeline of qualified investors who are ready to say yes to your next opportunity. Each week, I sit down with investors and industry professionals to unpack their journeys, key turning points, and practical strategies that you can apply right away. So let's talk real estate investing. Most people think you need a ton of money to get started in real estate. I know I did. But if you could build a portfolio, retire from your day job, and do it buying properties with 100% financing, what would you say to that? No joint ventures, no giant trust fund, no waiting until you had enough. Today, we're going to dive into creative financing with my guest, Rob Lamontagne, and we're going to talk about how he went from zero to financially independent in just 10 years using other people's money and smart deal structuring. Rob is a real estate investor, trainer, and a mentor who has been teaching creative financing and income property strategies for over a decade now. After building his portfolio while running his own computer consulting business, he officially retired in 2020 and has since helped countless investors learn how to do the same thing. Rob, this is going to be so good. Let's get into it. Welcome, Rob, and take us back, Rob, to ground zero, where you had zero properties, no massive pile of cash, and yet within 10 years, you were able to retire from your day job. What was the very first deal and what flipped that switch for you that made you realize this is possible?
Hi, Debbie, and thanks for having me on your webcast. I'm really going to enjoy this. It started actually in 2008. I'm self-employed computer consultant, so have no pension. And as anyone who has no pension knows, your retirement is going to be based on your savings. So
Even
I
if you
had,
have a job, though, Rob, a day job, your retirement is still so tiny. You're going to be poor when you retire.
so I had my savings, and I had them being managed by one of the big wealth management companies. And so my retirement savings were in a properly diversified basket of mutual funds and ETFs. And then September 2008 hit, and we had the global market crash that wiped out about 50% off the stock markets between September 2008 and April 2009. In that time frame, I lost about 60% of my savings. And so I didn't know what I was going to do. If you remember the old Manulife commercials from the 80s and 90s, they had this program for Freedom 55.
Well, I know that's stuck in my mind.
Yeah,
I've always had this goal of Freedom 55 because of those
exactly.
commercials.
Well, I had just hit Freedom 75 if I was lucky. So I didn't know what I was going to do. And then one day I was listening to the radio at work, and I heard this radio commercial that said, "Come to our free seminar and we'll teach you how to buy investment real estate with other people's money." And I said, "Well, what the heck? Why not? I got nothing to lose." So I went to the seminar, and the 2 hour free seminar turned into a weekend that they called basic training at the time, but was really a sales event to sell you more courses. But I must have liked what I heard, because I did end up signing for a series of 4 courses. And that included an income properties course that actually taught you how to evaluate properties, a creative financing course, a property management course, and an asset protection and estate planning course. And it was actually the creative financing course that got me really sold on getting into investment real estate, because the gentleman at the front of the room had been laid off from his job and did not have a lot of money. And he was in a position where he was starting from scratch, and he built a portfolio. And in a short period of time, he was able to have his real estate sustain him. And I just looked at it and I said, if he can do it, why can't I? And that was kind of the jumping point, where I started to believe in myself and in what I could do with the real estate. One of the key things in that course is he had a goal setting exercise. And in that exercise, we established our goals, and we did it according to the SMART methodology, where we make sure that they're going to be attainable and meaningful and time bound. And I set myself three goals at that time. One, that I was going to buy 5 multifamily properties within 5 years. Two, that I was going to retire within 10 years. And three, that I was going to have someplace warm to retire by the time I retired. And so, no, we were never gonna leave Canada because of the kids and grandkids,
Mhm.
but we wanted some place where we could be snowbirds and have someplace nice to spend the winters. Part of my plan was to start looking at real estate, and I started. And in those courses, they identified 5 markets at the time that were key targets where you could buy property, finance it 100%, and still have a positive cash flow. So at the time, those were Sarnia, Chatham, Windsor, Sudbury, and Winnipeg were the main markets that they were looking at. And Thunder Bay was another alternate market that it was also on the borderline. So I started following those 5 markets, and I set myself up a goal that 3 nights a week, I was going to spend at least 2 hours actually looking at listings and going through the properties. So on my lunch hour at work, as well as 3 nights a week, I would go through all the listings, and every property that came up, I would send a note to the realtor, and I'd ask them for their financial statements, their income and expenses, and I do the numbers. And I started making offers. And it took me 10 months to close on my first property. But by September 2010, I closed on my first property, a 15-unit building in Windsor. And the first one was 100% financed. It was financed with a conventional mortgage, and it was financed with a line of credit. My down payment was financed with a line of credit. So that's how I got started. And I've never looked back.
Excellent. A lot of people think that when they get started in real estate, they need to start with something small. It has to be like a condo or a single family home. But you started right away with a building. So it's a myth that you need to start with something small.
It's definitely a myth. The gentleman at the front of my creative financing class started with 2 12-plexes. He became my mentor, and I modeled what I was doing after what he was doing or what he did. And I started from there looking at specifically multifamily properties.
So where are you now, Rob? What have you over the last 10 years acquired?
Well, it's an interesting journey because my goal was to get 5 multifamily properties within 5 years, and that kind of didn't work out that way. Things change and evolved as I went on. So I started out with 15 units in Windsor, and then I bought 12 units in Phoenix, Arizona. I started looking, and we bought a condo in Ecuador, and then I started realizing that if I was going to expand, I was going to have to start using more than just lines of credit, and I was going to have to use more than vendor takebacks. Phoenix was financed with a vendor takeback. So I looked at other options. That's when I started getting into joint ventures and started doing rent to owns. I did a wholesale. I wholesaled a 12-unit building in Windsor. And at between 2010 and 2020, I actually transacted on 55 doors. And I was holding at any one time, I was holding anywhere between 33 and 35 doors.
So your goal was just 5 buildings in 5 years. And what did you actually have in 5 years?
Well, what I ended up with was 15 units in Windsor, 12 units in Phoenix,
Hmm.
2 in Buffalo, New York, 2 units in Niagara Falls, New York, 9 rent to owns across the Eastern Ontario.
Okay.
Like I said, a wholesale to 12
So
unit
you
building.
so you blew your 5 out of the water. We do underestimate ourselves. So you set that goal that you think and then multiply it by 5 to 10. to set those worthy goals. So that's amazing, Rob. Congratulations.
Thanks. And then in 2021, I pivoted. I was looking at the real estate and it was taking up a lot of my time. Uh, and so in 2021, I decided that I was going to try to restructure things so that it was less work for me. And I got an offer on my building in Windsor. I refinanced Phoenix. And then I took the proceeds of those and I basically became involved in larger projects. So I'm invested in cottage resorts in Ontario. I'm involved in 140 in Pasadena, Texas. I'm a junior partner in 9 storage facilities across the southern US. So the whole idea being is that now that I'd built up some equity and some value, then I wanted to redeploy that equity in order to expand the portfolio into things that were not going to take up too much of my time.
It was more part of your portfolio is more passive.
That's right. That's right. It was basically converting it from something that was more hands-on from a management point of view to something that was going to be more of I had gotten to the point where I could become an investor in other projects as opposed to me needing other people's money.
And Rob, are you able to now live off of the proceeds of your investments? That is it funding your lifestyle at present?
It's a combination of the that as well as my other investments and my other savings. Because over time, my goal was to then take my RSPs. I'm coming up to 65 now, and my goal as part of the transition was to use up my RSPs and then transition that into full time income from the real estate. And that's at this point where I'm at in the plan.
Let's get into the mechanics now of what 100% financing looks like. So when you say 100% financing, what does that actually look like in practice? What are some of the most common creative strategies you use to acquire properties without using your own capital?
Okay. So the first one was Windsor. And for that one, what I did is it was a conventional mortgage and my line of credit, I had sufficient room on a line of credit to go and borrow 180,000 from my line of credit in order to have the down payment on the building in Windsor. So that's the simplest and the one that I talk to people most about. If I'm talking to new investors in their 40s and early 50s, these are people who have a lot of equity in their homes and can go and they can secure a HELOC against their property and have access to the equity in their home as their down payment. And that was my first venture into 100% financing. The second one was Phoenix, and Phoenix was a vendor take back.
Explain for everyone what a vendor take back is.
It's essentially the person selling the property is going to hold the mortgage. And so the vendor in Phoenix financed everything except for $20,000, which I put on my line of credit.
Hmm.
So he ended up financing the entire purchase at 0% interest for 18 years.
Wow. I don't know if
So
we can find those kind of deals here in Canada.
no, no, actually, and that's part of it. Part of the whole process was learning not only Canadian real estate, but I did take courses on U.S. real estate,
Hmm.
and U.S. taxes and U.S. asset protection. So, in order to be able to venture into the states, you have to understand their system and the way it works. He ended up financing the entire purchase except for $20,000. And he needed that because he had some financial requirements for $20,000. And so as long as I could come up with $20,000, he agreed to finance the rest.
And you're like, let me write you that check.
Right off my line of credit. So yeah, I also did a flip, basically on my credit. Actually, one of the major home renovation and lumber companies opened up a commercial account, and with them, typically, as long as you turn around and your purchase for over $300, they're going to give you anywhere between 3 and 12 months of free interest. So I basically funded the entire flip with credit cards and with
Hmm.
a commercial account.
I think a lot of people don't think about their credit cards when they're thinking about what do I have to put into my investment. They don't
Yeah,
think about credit cards and those company cards. Especially when you open it for the first time, they
yeah.
sometimes offer you those deals of 10% off, or you don't pay for X amount of month.
Exactly. And then the other thing that I found, which was really interesting, is I found what's called a balance transfer card. And a balance transfer card is a special type of credit card, and it allows you to transfer a balance from another card onto it. And they typically will give you anywhere between 9 and 12 months of interest free financing for a small fee, usually between 1 and 2% of the amount you're being transferred. So I went about getting myself some balance transfer accounts and was able to use them to actually make purchases. And as a result, so I put it on my credit card, I get 56 days interest free, and then I roll it into the balance transfer card and get a year interest free.
My mom always said, borrow from Peter to pay Paul.
Pretty much. But the thing is you just have to be aware and plan it because you
Mhm.
know that in the year you've got to have the transaction completed and that money paid back. And then you just rinse and repeat.
Yes.
The other thing I did is I did rent to own, and I did rent to own with joint venture partners. The joint venture partner would come in, they would qualify for the mortgage, and they would provide the down payment, and I would find a tenant in a property, and I would manage the property. And at the end of the investor with the funds, and I would split the profit. I did 9 of those. Overall, that was a very successful strategy as well, as long as we were in a market where we could charge enough rent to cover our costs. And that was the big thing. You have to really understand your numbers in this business because what you have to do is be able to ensure that your costs are going to be covered.
Yes, so that you're not out of pocket at any time. And that includes considering like reserves, contingency fund.
Absolutely. Now, for contingency funds, what I always did is instead of keeping active money in a contingency fund, what I did is I opened a $50,000 line of credit. And that's what I kept active on the side. So in the event that I needed funds, I did not have funds set aside that weren't being used. I had access to $50,000 in credit that if I needed it, I would be able to use it. And I did. At one point I had to redo a roof on a property, and that's where the funds came from.
That's a
So
great mitigation strategy for everyone to,
mhm,
not tie up funds just sitting in a savings account.
yep,
But if you have a line of credit, or if you can open a business line of credit like you did, you know that if something does happen, you have a source of cash to go into. But you don't have to, you're not paying anything out or
you need it.
losing any interest
That's
while
right.
you're waiting for something to possibly happen.
And then a strategy that people don't realize they can use is actually a cash out refinance. In Phoenix, those properties actually appreciated in value fairly quickly. And in 2020, I actually refinanced Phoenix and pulled out enough money to become a partner in a partnership of self storage facilities. So that the refinancing of Phoenix actually funded the purchase of a partnership in 9 storage facilities in the States.
What I love about that strategy is you don't get taxed.
No, absolutely not.
You don't get taxed on it. So you're paying yourself without getting taxed on it because it's rolling into, again, another investment.
It's rolling into another
Another
investment, and
investment. So,
as long as you're doing a refinancing, I mean, that's borrowed
mhm.
money.
Yeah.
And then Phoenix was doing so well that the income from Phoenix was actually paying fully funded and cash flow positive on the borrowed money to purchase into the partnership of self-storage.
Wow. So that one money that you took out of the refinance, then in essence financed two opportunities.
That's
It
right.
financed Phoenix, which did so well that you were able to finance the self storage.
So it's really been a combination of private borrowing, private money that I actually financed the purchase of the condo in Ecuador, 100% financed with a private loan from Canada. So I sorted out a private loan from Canada and had the money to pay cash for the condo in Ecuador because we couldn't finance anything in Ecuador. So the strategies have involved lines of credit, credit cards, conventional mortgages, private lenders, private loans, JV partners, cash out refinances, really all different strategies that you can use to access money to make purchases so that you don't have to put any money out of your pocket. Because when I started out, I didn't have any money left.
Yes, and that's what a lot of people, including myself, thought.
I put off getting into real estate investing for so many years because I kept thinking, I need a savings. I need a savings. And I had kids and I just wanted to give them the best life that I could for them. So I just spent all my money on them. I didn't have a savings. And so I always thought, oh, I can't get into real estate investing. But I was sitting in this house
Mhm.
with all this money. And situation like what you just said about financing the Ecuador condo. Well, I had an opportunity in 2009 in the US, in Vegas, to buy properties. At that time, I didn't know anything about real estate investing. And I didn't even think about the fact that I had a line of credit. As a consumer, you don't want to use your line of credit. You think it's there for an emergency, so you don't touch it. My mom was living in Vegas in the townhouse development that she was in. People were walking away from their homes and they had bought it for like 150,000. And then the banks were selling it for like 43, 50,000. And I was like, oh, I would love to buy one of these, but I can't get a mortgage here in the US. And I had all these excuses and I never did. And then when I learned about real estate investing and I think back to that, I could have written my line of credit and bought like four of them without blinking by just
Absolutely.
using
Yep.
my line of credit. I missed that opportunity because, I didn't know at the time. You don't know what you don't know.
Yeah, exactly.
So, anybody looking, especially in foreign areas, at some where prices are cheaper, it's possible for them to do that. They don't have to worry about how do I finance in that country if they've got their line of credit and can finance it from here.
Or you structure it with private loans. It's not difficult to get private loans in Canada as long as you have the ability to provide them some kind of security or some kind of collateral or access to collateral in the event that you default.
That could be on your own home.
Yes,
I'm
yes,
thinking of that.
exactly. And so when I bought in Ecuador, I gave access to my building in Windsor that if I defaulted, that that they would be able to put a mortgage on my property in Windsor in order to make sure that they could recover their funds.
That's important.
In 2017, I started to get into private lending to actually supplement how my retirement income was going to look. So my RRSPs at the time started going into private lending, and in order to generate further income, and use real estate in a more passive way, where you become the lender as opposed to you borrowing.
I want to highlight, put a disclaimer on that. You need to do your due diligence. A lot of due
Absolutely.
diligence. A lot of people have lost their shirts recently in that because they just trusted the person and didn't do proper due diligence.
And, and
Right.
in fairness, even if you do your due diligence, there's
It's
risk.
there's still
Um,
risk. Yes.
I've done 19 private mortgages and 17 have gone really well and 2 have not. And the 2 are in the courts for foreclosures and ended up in quite a mess. Everyone who's involved in private lending and real estate in Ontario knows about some of the messes that were involved with a very credible mortgage broker at the time that everything turned bad. And even if you did your due diligence,
Yes.
um,
So that money is high risk and there is a possibility of you losing it.
absolutely.
So go in with your eyes open there. I know I've got a few with companies that I thought were pretty credible. They were paying pretty well for like 3 years there. So I didn't worry about it. And now I don't see any statements. I don't hear a word from them since May of last year.
But that's part of if you're going to be getting into the real estate, you have to develop a certain risk tolerance, and you also have to develop flexibility that the general people do not have. You have to understand if you're going to get into dealing with individuals that your timeline may not be exactly as you plan. There may be a requirement for you to be flexible as a lender and delay the timeline, delay the return of the funds. Just like when I did a rent to own and the tenant didn't qualify for their mortgage, and I had to go back to my investor and say, I'm really sorry, but that we were asking for an extension because they didn't qualify for the mortgage. They need another year. When we did the rent to own, I did identify this as one of the risks, and you were okay with it. And unfortunately, in this one, the tenant has come back and needs another year. Are you okay?
Yeah. Well, we
And
don't live
whereas
in a perfect world, so things
no,
happen. Development permits don't come in when they're supposed to, and
that's right.
a lot of things change.
And whenever I talk to my investors, that's one of the key things that I ask them is, how much do you have? How long can I have it? And how important is it for you to get it back on that date? What are your other plans? You need to be able to talk to your investors and talk to the people with the money in a way that they understand that if there are hiccups, we need to be flexible and we need to work together to resolve the problem.
Well, I was always say not all money is good money. Just because people are wanting to give you money doesn't mean they're the right people.
No,
There
that's right.
you do have to make sure that they understand the terms and conditions of under which they're doing that.
And their experience in dealing with private investments is a big help. If you're dealing with somebody who's done private investments in the past, they tend to be much more flexible than someone who is new to private investing and to be much more rigid in their view of real estate deals.
So creative financing sounds really exciting, but it also, as we've just talked about, it sounds risky to some people. What was the most stressful or high pressure moment in your journey using these strategies and how did you navigate it? So I know, Rob, before we started the call, you said, I never feel stressed about my real estate. So what are some of the obstacles that you faced?
We had some challenges in Windsor with maintenance issues that we were not anticipating. We had issues with the roof and it needed a $36,000 new roof. But again, the risk mitigation strategy in place there was that I had a $50,000 line of credit. So I was able to pay for the new roof. I would say the biggest stresses have come in private lending more than in the physical real estate where I became the lender, where we've had a couple of situations where people have defaulted on their mortgages and we've had to go through the legal process of filing claims and foreclosure and dealing with the courts in order uh, to take over the asset and sell the asset. Those are probably more the most stressful sides of the real estate business when things go wrong on that level, because when you're dealing with real estate situations, you're always trying to make it so that you're in win-win situations. You're always trying to solve problem so that there are no losers. Everybody is made whole. And when you're in a situation where people are defaulting on their loans or you're having to repossess homes, there are people who are losing and there's nothing that you can do about that. And that is probably the most stressful side is when you can't resolve something in a way where everyone is left whole.
Yeah, that is stressful. I also feel that at least when it's your investment, you have control, you have your plans, you have your mitigation plans, you have triggers that you can actually pull. When it is somebody else that's looking after your money and you're trusting them, it's also harder for you when something goes wrong
Absolutely.
to actually enact anything that will, get you out of trouble.
Well, and it's more than just getting you out of trouble because you're in a position where in order for you to get out of trouble, somebody is going to get hurt.
Definitely. I get that. Oh. So let's talk about your retirement. At what point did you know you were done with the day job, the consulting? And was there a specific number, a cash flow milestone, or just a moment where you thought, that's it? I don't need this job anymore. And you weren't an employee, but you were a consultant when you
Mhm.
decided, I'm not going to do this anymore.
Well, it was actually a 10-year plan. From the time that I started in 2010, I said, "Okay, I'm gonna give myself 10 years." And I was not concerned in that 10 years about cash flow. I needed my properties to cash flow positive, but I
Mhm.
wasn't concerned about the level of cash flow because I was going to keep my day job for the 10 years.
Okay.
And so I wasn't relying on the real estate for income and was basically turning all the income from the properties back into investment in more properties, back into investment in private lending, back into investment to generate other income. And so it was a time frame that I set for myself of 10 years. And then in the first period after that 10 years, that is when the plan was to use the RSPs. So we were going to rotate the hard assets into assets that were going to produce more income while using the RSPs to fund basic day-to-day life. So it was more than a point in time. It was actually and planned life budget and transition from a day job to being able to live off of the real estate. That also involved teaching and coaching on the side, and basically getting involved in helping other real estate investors accomplish their goals.
So you stayed the course. You kept to your plan. And
Exactly.
right. I had a plan, but mine I got laid off and I didn't want to go. Sometimes things happen. Some people get anxious and think, I actually can't do this anymore. I just want out of here. And others like me got laid off. So I was like, okay, this is God's way of telling me go another route. But that's great. I love it, Rob. You're organized, you're structured, and you keep to the plan. And I think
Well,
that's where you say, I'm not stressed. It's because you have
a
you're
plan.
organized, you have a system, you have a plan, and you follow that system and plan.
And I think the other thing is part of the hype of getting involved in real estate is people telling you that you can retire in 1 to 3 years, or you're going to be financially independent in a year. And my plan was to work for 10 years. And part of that was to say, with a job, I'm going to be able to qualify for mortgages. So hugely important was to have that income in order to qualify for the conventional mortgages that I needed in order to be able to implement the plan. Um,
Yes.
people don't realize that part of creative financing does involve conventional financing. Creative financing supplements the conventional financing, and that invariably you're using creative financing as a bridge gap to some form of conventional financing. And the ability to have a job while you're building the plan and while you're building the asset base is that you're able to have easier access to money.
Yeah. So don't be so eager to get rid of that job. And if you're anxious, just think about what it's getting you, what
That's
that
right.
paycheck is actually getting you.
Eye on the prize, always eye on the
Yes.
prize. And it's amazing when you have your eye on the prize and you've got the goal, it's a lot easier to put up with the more unpleasant side of being employed.
Mhm.
You tend to be much more tolerant of the job, if the job is getting you to the end goal.
Years ago, I was having one of these moments where I just didn't want to be in my job. My boss was very toxic. And I put a note out there as how do you stay in your job when all you want to do is real estate? How do you motivate yourself to stay in your job? And I think you said that. I think you were
I
one of that said,
I
keep on your eye on what the job's getting you. Think about that part.
I believe that's how we first met.
Just remind me that I'm sure that was you that said that to
Mhm.
motivate me to keep going. So, for someone watching this who's thinking, this sounds great, but it won't work for me, what kind of mindset shift do they need to make? What's that first step that they should take if they want to explore creative financing seriously?
Well, I have several quotes that I use regularly when I talk to people. And the first is whether you think you can or think you can't, you're right. And that's a Henry Ford quote. And it basically says if you start with a defeatist attitude, you're going to be defeated. You're already defeated. And I work on people as part of my coaching, and I work on their mindset. You have to start believing in yourself and believing that you can accomplish it. And that is number one. The second thing that I look at and I talk to people is I say, you don't know what you don't know. And the importance of getting some training and some education is so important. I hear all the time things like, you can't do that, it's illegal. Well, what most people don't realize is that anything that's agreed upon between two consenting adults is perfectly legal as long as it's not explicitly illegal. So you can't turn around and say, I want your help to rob a bank or kill someone.
Yeah.
Okay. But if you come to a business arrangement with somebody, that is perfectly legitimate. And as long as you are both uncoerced and do it willingly, all is good.
And
The
it's written and signed
And
off.
it's documented, absolutely. The other thing I think that is a big problem for people is that they start with the wrong framework. They're always saying, "Can I? Can I? Can I?" And when you phrase it as a question asking permission, Okay. You're taking the power away from yourself to accomplish something. I tell my students that when you're doing this, you have to rephrase that. It's not can I, but how can I? How can I? And that's really the basis of the framework and mindset. And when you start to realize that life is a problem and everything that you deal with is a problem, and what you're looking at is that you are a solutions provider. You are looking to find a solution to someone's problem. And every seller has a problem. They're selling their building. They're selling their
Mhm.
property for a reason. And once you've determined what the seller's problem is, then you're in a position to be able to offer them something that solves their problem and can do something good for you at the same time. That's how I ended up accomplishing Phoenix. I found out what the seller's problem was, and he needed $20,000. As long as I got him the 20,000, then he was willing to work with me on the rest. Once you take the time to invest in learning what the other person needs, you can make just about anything happen. So those are really the prime concepts of what I try and work with and switch people's mindset from can I to how can I? And I believe in myself and I believe I can do it. That's what the trainer in my creative financing course did for me. Based on his stories, that's something I do. I tell stories. So I will tell stories how I bought my buildings, how I financed them, how I made deals, how I did transactions. And I tell the stories. I link a specific strategy to a story. That's what my trainers taught me was that the first thing you have to do is switch your mindset. And if you look at what I did and how I did it, if I can do it, there's no reason you can't. There's
Exactly.
nothing special about me. I started out with nothing. I can do it, so can you.
Okay.
And that's how I try and approach it with people who are doubting that they can do it.
And that's exactly why I do this podcast, is to show all these different people from different walks of life, different starting points, doing real estate and doing it with different strategies that work for them. The storytelling is so important. And that's especially why I asked, tell me a bit about your journey, how you got where you are. So the part that you said about refinancing, taking that money out, you don't pay taxes on it and then reinvest it in something else because it's just a mortgage. You're just borrowing more money on a
Mhm.
property that you have. And I sat there going, wow, you can do that and it's legal.
Exactly. But again, people don't know what they don't know.
Yes,
And until somebody sits you down and says, "Well, have you thought about doing this?" It's like you're kidding.
that's
Eh,
possible.
I'm coaching somebody right now who is looking to buy a house and they don't have the down payment. They don't know how to go to the owner and they want to do a private sale with the owner. And the owner needs money to be able to go and move forward and buy their new house.
Hmm.
And so I was explaining to them how to do the numbers for the owner and show that, well, if we take the current property and we refinance it, you're going to be able to get 80% of the value of that property. You can then take that 80% and then you can then go and buy your other property. And I will go into a rent to own situation with you where I will pay you back. I will, number one, rent your property for the next 2 to 3 years. And then I will be able to qualify for my mortgage and I will save enough of a down payment to actually pay you back. But in the meantime, you're making cash flow. You've got the money that you need to actually buy your new house and I get to buy your house.
There are opportunities, like you said. How can I do this? How can I make it a win-win for
Mhm.
everybody?
It's mindset. Mindset is everything.
Definitely. I have one last question for you, Rob, before we wrap up.
Okay.
Uh, if you could sit down with a version of yourself who had zero properties and was just getting started, knowing everything you know now, what would you tell him about creative financing and the risk and what's actually possible?
Make sure you understand your numbers. Your 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 greatest liability is a lack of understanding of your numbers. Most new real estate investors fail because they fail to understand how to sort out their income, their expenses, and their debt service to make sure that they positive cash flow. That's number one. The other one is don't listen to your family and friends. Your family and friends are talking to you from their comfort zones. And my family were, you've got to be kidding. You're going to borrow against the equity of your house. You're nuts. Your house is your safe asset. Family and friends, they're there to protect you. And their goal is to see you not get hurt.
Yes.
And so you want to immediately put aside the thought that your family and your friends are going to give you the best advice, because they're going to give you their advice from their perspective, not necessarily the perspective you need.
Unless they themselves have all these properties.
That's right. And in my family, they did. Like, I
Mhm.
was being told I was nuts. The other thing that I think people have to get away from is the fear of going outside their local market. So many investors only want to buy a property in their market. But when I started out, I was in Ottawa. Nothing in Ottawa cash flowed. Nothing. So I looked at it, and if I was going to be able to successfully get into investment real estate, I had to go elsewhere. And that's where I ended up in Windsor. I ended up in Phoenix, because I learned that I was going to have to hire a property manager. I was going to have to learn to give some control. And my job was going to be to manage the people to whom I had given control of the direct management. You have to become comfortable with working outside of your own market, and you have to be comfortable with the whole concept that you are a high level manager. You are up here, and what's happening here is what you're controlling. What's happening below that is up to the people that you've hired to do it.
And that's where you have to build a good team.
You have to. And the last
Team
thing,
you can trust.
getting back to numbers, is when people start doing their numbers, they forget four key components, because they're going to be looking at a financial statement that's been provided by a seller or an agent. And there are key things here that they need to realize. The first is on the income side. The minute you see market rent or potential rent, you know that the tenants that are in there are not paying market rent. So you have to make sure that you're getting actual income, not
For the tenants you're
potential,
inheriting.
yeah, that are there now. Because if you're in a province like Ontario, okay,
Oh,
if you've got a
BC.
tenant, if you've got a tenant who's been there for 10 years, you're not getting them out and increasing rents. You need actual numbers.
They're not going to find the rent that they've been grandfathered
That's
into
right.
anywhere. So
And you're not
what?
getting rid of them.
Yeah,
So
you're not.
so you
There's
need
nothing
actual
gonna get them
numbers.
out of there.
And then on the expense side, I call them my forgotten four. And they're vacancy, interest rate fluctuations,
Uh-huh.
management. And people always criticize me, but I say, look, okay, your lender is going to use the vacancy rate in your market as reported by CMHC, or 5%, whichever is higher. So if
Mhm.
that's what your lender is using, that's what you should use too. And expect that you have to analyze not only the market for the city, but every city has suburbs. You have suburbs in the outskirts, they're bedroom communities. You've got your downtown core, you've got higher income areas, you've got working class neighborhoods, and the demographics, tenant profiles, vacancy, all of these things are different for each of those areas within the city. And so you have to properly look at those things when you're looking at your vacancy.
You have to compare apples to apples, so
That's
you
right.
need to get right down to neighborhoods.
That's right.
Yeah.
And when it comes to interest rates, I always tell my students, you use the current 5-year posted rate plus 2%. You never do your numbers at less than 5% or current 5-year posted rate plus 2.
Mhm.
And I look at them and I say, I've been doing that. That's the way I was taught in 2010. That's the way I teach my students. And the government thought that was such a good idea that they implemented the stress test, which is pretty much exactly that in 2017, where they want to make sure that you can afford, if you have an interest rate increase, that you can still afford your mortgage.
Right.
And then on the management side, I always tell my students, you need to put in there somewhere between 5 and 10% cost to manage the property. I found a sweet spot somewhere between 7 and 8% that I can get decent property management. But even if you're going to manage the building yourself, you have to make sure you put in 5% for management, because you don't work for free.
Right.
You're going to
And
manage.
when life is going to change for you,
No,
you will
exactly.
have to outsource
Yeah,
that.
absolutely. And then the final thing is maintenance. When you're looking at financial statements from an agent or from a seller, they're not going to have any maintenance numbers in there. And I always tell my students, you start at 5%. If your building is less than 15 years old, you always budget 5% of your income for maintenance. If your building is between 15 and 30 years old, you budget 10%. If your building is over 30 years old, you budget 15%. And that goes straight into your numbers. And by the time you take your actual numbers, your actual income, your actual expenses, and you add in the forgotten four, you've got a reasonable financial statement that if you're still cash flowing positive, you've got something that you can look at as an investment that you want to look at. And again, don't stick to your home market.
Yes. One I find a lot of people forget to is the down payment if you're using your line of credit.
That's got to go into your debt service.
They forgot that they took their line of credit and they're having to pay that percent every month. Amazing. Thank you so much, Rob, for your time. I think we could go on forever, but
Oh, it's been my pleasure.
it's such an exciting topic for us.
Thank you so much for inviting me. It's been great.
To those watching this podcast, before you click away, do two things for me. Hit that like button to this video and hit the subscribe. Stay strategic, stay visible, and keep building wealth with intention.